Doing well. Welcome to the ABS Anticipatory Breaker Strategy. Before we get started, I'm not a financial advisor. It's not financial advice. Everything in this video you need to do your own research on, and I'm not saying you should use real money with any of this. It is all informational. It is what works for me. It does not have to work for you. All right? So now that we got the inevitable out of the way, I want to show you guys a few things in here, okay? So just this year, thousands of dollars in payouts, okay, and 24 funded accounts passed in the last 20 days. I'm showing you this to show you that if you put your head down and learn what I'm teaching you in this video and in the few videos to come in the series, you're going to see success, okay, with a demo account, because I'm not a financial advisor, all right? So just remember that, I'm not a financial advisor, okay? I'm just showing you this because it is possible. Okay, it is very, very possible if you just focus on what I'm teaching you, okay? So, let's get right into it. Module number 1 of the ABS Anticipatory Breaker Strategy. The anatomy of a breaker block. Bullish breaker, low A, high B, low C, high D. Bearish breaker, high A, low B, high C, low D, okay? Here, bullish breaker, A, B, C, D. A, B, C, D in the bearish scenario. The strategy focuses on catching C to D, okay? And beyond, right? Module number 2, external versus internal breakers. So the external breaker is going to be the A to B, okay? Like this. Okay, another A to B like this, another A to B like this. So I'm only showing you this. Don't think of it too technically. I'm just showing you this so you can recognize what the external breaker looks like versus what the internal breakers will look like, right? C is going to be down here, okay? I call C the C spot, okay? It's the most important part of the entire strategy, and it's going to have nearly an entire video dedicated to it, all right? So why external and internal breakers are so important is because they create low resistance liquidity, right? Notice here, we're taking out sell side. Each one of these moves is taking out sell side, but we're leaving buy side untouched, aka engineering buy stops. Smart money wants to sell the top buy stops, right? And it's going to be like rocket fuel to get up there, all right? So, that being said, let's go find it on the charts really quick. I always want to show examples, okay? Okay, let's find some good examples here for you guys. All right, beautiful. So here, I know it's outside of the kill zone, but it's just a good example. We're gonna go over here. Okay, and then we're gonna go like this, and we're gonna go replay mode, and we're gonna go here, okay? So I only want you focusing on what's on the screen. Notice here, we have a low, a high, a low, a high, a low, a high, a low, a high, low, high, low, high, low, high, low, high, low, high. You get the point. Throughout this run, we fail to take out buy stops, like this, and we're engineering more buy stops, right? Notice the equal highs here. We come up, fail to hit the high, fail to hit the high, create relative equal highs here with this high, right? Barely goes above it, super clean action, right? Meaning there are going to be buy stops resting above all of these highs. This whole run here, there are buy stops, okay? And you're gonna notice there's breakers that we're anticipating to form, right? A, B, A, B, A, B. Now, like I said, we're gonna have a full video dedicated to finding where C is going to be, right? So this is not C, A, B, C, that's not C, right? Because C has to be the lowest low we form before our reversal / retracement. This is C to all of these anticipated breakers. A, B, that's not C. C's all the way down here, right? All of this is clean price action that we want to see traded through, okay? So that's what I want you guys to focus on seeing and focus on trading, okay? And notice like this here, just super clean. Notice this, clean, okay? Smooth edges like to be made jagged, okay? So, like it says here, internal and external breakers are very, let's fix that, important when we have multiple breakers with the A, B, and C legs. It creates, C leg actually, idiot. It creates low resistance liquidity for our anticipated expansion. Module number 3 is the anticipatory breaker strategy entry vessel. This, we use the inversion fair value gap. When anticipating a C to D leg expansion like this, we need to look for a fair value gap or fair value gaps on the B to C leg, okay? This fair value gap or fair value gaps is what we will use to enter once inverted. In a bullish scenario, the B to C leg will be a run lower, below A's low. On the B to C leg, we will look for a singular fair value gap to be inverted for us to initiate our long entry. If there are multiple fair value gaps, we must wait for the final one closest to our target to be inverted. No. If there are multiple, you must look at a slightly higher time frame to see if it's a singular fair value gap on that time frame. So, imagine this is the 1 minute, and imagine we have multiple fair value gaps. Ignore this. Imagine there's multiple. You need to go to the 2 minute, 3 minute, 4 minute, and 5 minute and see if it's just one fair value gap on one of those time frames, okay? In this example here, it's a perfect example because it's a singular fair value gap on just this time frame. Once it's closed through, we can take our entry, okay, targeting B's high as our first target in most scenarios, but we're going to get into all the little details in future videos, okay? So let's get into the charts and I'll show you a few examples, all right? So right here, what you're going to notice, I'm going to zoom really close in here. You're going to notice we have a low, we have a high, we then run the low, tap into the order block in here, right? And now, where's our entry? Well, we have a singular fair value gap. Okay. Once closed through, we can take an entry. Okay, I'll get into stop loss placement later. Okay, we'll just go with if it closes back through in this scenario. If it closes through this fair value gap. So we'll put it there. It would be a manual stop loss, right? And let's say your first target is always, almost always, we'll get into when it isn't, the high, the A to B high, right? And that's where you're going to go break even. Okay, this is the way your win rate is going to be very high. Your next target, you're going to look left. Always look left. Where's the next anticipated breaker? Well, the next anticipated breaker would be here, right? We have a low and then a high, right? Technically, it would be here as well, but this one's directly above it. Okay, so we'll target that one as well, all right? Then, again, stop break even. After this, if it's above a 1.5, whatever risk reward ratio you prefer, that's when you take 75% off whatever you'd like and let the rest run, right? So let's find a few more examples here. Did that one close? Technically, this is not a great example here, but I'll show it to you because they're not always going to be perfect, right? Again, we'll zoom in really good so you can get the detail. We have a low. We have a high. We run the low. We're anticipating us to run the high, right? So you'd want to see the fair value gap. In this scenario, you need to include the volume amount. This is actually a good example. Okay. If there's a volume imbalance with it, we have to close through the volume imbalance as well. Notice here you wouldn't get an entry because this candle, I believe, would be like a NFP candle. Yeah, it looks like NFP. Closes through it, no entry, right? Because it already hit the high. It already hit the high. Okay, so if we hit the high before closing through the fair value gap, then there's no entry, right? It's pretty simple. Okay. Wow, this is some interesting price action. Oh yeah, it's because I'm trading at 4 in the morning. Yeah, that would explain it. All right, so let's find a few more. Is there anything in here that we can see that's really clean? Yes, there is. Notice this is a beautiful setup. Why is this such a good setup? Well, notice we are clearly bearish and we run higher, right? We fake higher, okay? Notice when, right after the 10 a.m., okay? Now, we trade higher. We start re-delivering from a fair value gap. Notice here we have a high, a low, and a higher high. What are we anticipating? We're anticipating a lower low, meaning we identify our singular fair value gap like this, okay? Once closed through, my preferred stop loss would be if we close through a bearish PD array. If you watch Dodgy, he trades inversions. He does if it closes back through the inversion. I don't do that. I choose a bearish PD array. So if we invert the fair value gap here, then I'd want to be out of my position. So my stop would be here. This would not be a limit order stop. It'd be a manual stop. Okay, it'd be a manual stop if we close through it. Let's just pretend. Let's get an accurate risk reward. Let's say we probably would close around there. Okay, and now we're targeting the leg, the A, B, C, D as our first target, okay, and then we have inefficiency right below it in here, so we'd want to see this inefficiency get filled, right? Again, I'm not cherry picking examples for you. I'm showing you realistic examples of above 1 RR trades, above an 85% win rate. If you do crazy stop to break even stuff, you can get it from 85 to 90, right? But most of you will be around that 70%-ish range until you master a little bit more, right? So let's find a few more. Okay, beautiful example. Beautiful example. We have a high resistance high. I believe this is CPI maybe. You'll notice we did not want to hit this high, right? We already ran the buy stops like that, so we did not want to hit this high yet. Doesn't mean we won't ever, because I believe we already did. We just didn't want to hit it yet. We wanted to engineer more liquidity, right? So what you'll notice here, we have a high, a low, and then we run the high, right? Now we're anticipating what? If the high time frame narrative fits our anticipation, we hit a key level, we hit liquidity, we have an SMT, something that's giving us signs that we will reverse, which we're going to get into in future episodes. I'm just giving you the basics right now. We see, where's our fair value gap? Well, we have a fair value gap here. Do we enter when this one is closed through? No, we do not. Why? Because we have a lower one that we could react off of. So we choose this one here. Once it's closed through, we can take our entry. Where's my stop? My stop is going to be if we close back through the bearish fair value gap. Okay, so let's say we would close around here. You don't set a limit order stop here. You watch it. You can set a limit order up here just in case we do something crazy, right? But if we close above it, that's when I'd want to get out of my position. Okay, and where am I targeting? Well, you'll notice here, A, B, C, right? A, B, C, A, B, C, A, B, C, right? We have internal and external breakers. Where's my first target? Well, it's below this low right here, the most recent swing low. Then where am I targeting? The next A, B, right? And then where's my external target? The low down there, right? We're not going to get into standard deviations in this video. We're not going to get into reversal profiles in this video. I'm giving you the very basics you need so you don't ask crazy questions about the basics in the future videos, okay? So I hope this first part makes sense. Again, you have to watch the next videos to understand because the reason people lose is because they just think once they see high, low, higher, high, they think it has to make a lower low. No, it has to line up with high time frame key levels, predetermined high time frame market reversals, right? Or retracements, right? A low time frame reversal is really oftentimes just a high time frame retracement. So in future videos, we're going to go over how to actually know when we're going to either go like this. We're going to have low, high, lower, low, like this. How many times we're going to go hit the high, or if we're going to go back lower, or if we're going to go up, engineer more liquidity, and then go lower, and you're going to get stopped out. That's what the next videos are going to focus on. We're going to keep going deeper and deeper until you have a very solid understanding. And yeah, I hope you learned something in this video. Again, very basic. So if you do want to trade live with me, I trade live around 3 to 5 days a week, depends on the news. Obviously, I want to trade with high impact news, economic calendar, stuff like that. If you do want to learn more, just everything on the charts. Feel free to join the Discord and the WAP link below and trade live with me. Forex, future signals, all that jazz if you are interested. But yeah, I'm going to try and get a video probably every other day, maybe every third day, something like that. Try my best. With school, it is a little difficult, so bear with me. All right. But yeah, I'll see you guys in the next video.